Silicon Dragon, let's welcome our panelists here. And I will actually start with you, Glen. Sequoia Capital, yep. He's hidden. Okay, there he is. Yep. Glen, what's the secret behind Sequoia Capital China? I mean, they're in on every deal. How can this be possible that they're in on every deal? They're in on practically every IPO. How is this possible? What's the secret sauce there?
The real secret I can tell you, but I think the party line is basically, I think we've been here early. We've been here long enough, and I think when we first got here, the space was not that competitive. We've been lucky to assemble a good team and very stable team, and we've been lucky to partner with some of the best entrepreneurs in China, and I think one thing led to another. So somehow we are lucky, I think.
How big is the Sequoia team now? Sequoia Capital China team.
Yeah, we have about, I think, 160, 170 people, and I think about 60 people are doing investments. The rest are back office, finance, marketing, legal, and we have sort of four product line. We have the seed fund, venture fund, growth fund, and we also have a R&B fund. So those are the product line for us in China.
So to be a partner at Sequoia Capital, what does it take to be a partner there?
Make money.
Anything else?
That's it. I think. I think that's. I mean, that's simple, right? I think that's actually one of the best thing about not only about Sequoia. I think about any good sort of investment company. It's you have to be sort of performance-driven, meritocracy, and I think making money is the only thing that really matters.
Okay. Well, we do have a lot of money makers here. So James, I do want to switch to you next because James is behind two of the biggest IPOs recently, Meituan and Pinduoduo. So how has it happened that you got involved in both of these?
Meituan, actually, I invested in the Dianping 11 years ago. And so I was, if you look at a startup, and it takes time to build enterprise. And later on, they merged with Meituan, and now went public, about $40 billion. But when I invested, the company was have zero revenue and a 20 million valuation, and we put $4 million and only 20%. But it's what's attracting to me is I think when people talk about food, and but the model itself, at that time I was thinking it's there's only one winner in one market. It doesn't matter someone else, and it's throwing the money, and whoever is leading, and eventually become bigger. And the mobile is going to just make it even stronger. Pinduoduo is different. Pinduoduo is totally on the other end of the extreme, and the company started 3 years ago. I have known the founder for 14 years, Colin Huang, and he also was at Google as engineer. But he's a very unique person, and he would come to me. I joined Google way early, and he would talk to me, and then you have met Colin, and he said, I want to learn how to make products and how to build companies and learning the business. So he is the first person quit Google China 11 years ago and built the first company, and then that's in e-commerce space, and then build a second one. So when he came to me talk about the third company, he said, I want to do something having bigger impact. But the idea he had at that time was, there's a company called Jia. So the manicure in the company business, that you can have a mobile app and you place order, someone can come to your office or home to do manicure for you. So that's the idea he is thinking about. So I said, wow, that's not going to be really productive, right? And we should think about what he has been doing very, very well is in the e-commerce. So we tried to figure out together. And there's a Jet.com model, very successful in the US, at least raising funding. But how do we do it very cost-effective using acquiring user? But at the end of the day, that they create, he's an exceptional entrepreneur now. The company started 3 years ago. Now it's a public NASDAQ company for 20 billion US dollar market cap. So that's the exciting part. And as a VC, we are here, and we are excited about working with these top quality entrepreneurs.
Yeah, I just did a bunch of interviews with the China tech giants, and they all were mentioning Pinduoduo. It's kind of threatening them, I think.
So yeah, it is true. And some reporters saying, oh yeah, they get a lot of negative press, right?
Yeah.
That's because the competitors are really worried about.
Yeah.
You think about any business model can build a paying user customer base, 300 million from zero in 3 years. That speaks about the power of the model, right? And so they.
So we may see some disruption among the tech giants in China?
I think so.
Yeah.
I think everybody think BAT is so big.
Yeah.
E-commerce has a Taobao and the JD.
Yeah.
It's impossible to do something, but I think there's always a company in the garage
Right.
that's going to come out and do something
Right.
very different.
Right. So, Wei, from China Creation Ventures perspective, this is a fairly new fund and seems to be off to a great start. And so, tell us about China Creation. I'm familiar with your background, but I think many in the audience are not. So, why don't you share a little bit of what you're working on today and what kind of investments you're making and your view on China tech?
Okay, thank you. China Creation Ventures is the youngest fund among all of us. I think it's launched last April. We were actually the whole team, the 5 senior members from our current team, the whole team from Kleiner Perkins China TMT team. We was a founding team member since early 2007. Being with Kleiner 10 years, lead all the China TMT investment in past 10 years. And we decided to build this independent fund together to better capture the opportunity. You know, China have a lot of innovation happens. Everything moves so fast, like James mentioned, Pinduoduo only 3 years from zero to such a big giant. With a global investment committee structure, it's very difficult for us to make this kind of decision. So that's a key reason we want to do this independent fund. We're doing pretty good. We raised a 1.5 billion RMB fund last year, and we closed our US dollar fund about 200 million early this year. So within 1.5 years, we managing over 400 million US dollars. We have a 16 people team, just 10% of Sequoia. Actually, it's already bigger enough because when we were with Kleiner Perkins, the whole TMT team in Kleiner China only have 5 people, including me. So now we more than double our team, and we continue very passionate about early stage TMT investments in China. There's always something surprising us. You know, last Q1 we made one investment in a company called Wanka Huanju. Only within 2 years, the company already been approved IPO this month in Hong Kong. It will IPO in 30th this month. I will come back. So there's a lot of things surprising us again, just like Pinduoduo. I think all the JD.com investor, I'm the JD.com investor when I was in Kleiner, missed Pinduoduo from beginning because everybody in JD.com investments community, we all think the game is over. E-commerce game is over. That's what we think. Right. We actually gave up e-commerce market for a while, but then this happens. So it's a totally new story. Actually, if you look at the Pinduoduo and JD.com, many people don't understand what's the difference. Actually, the difference is for Alibaba and JD.com, the old generation e-commerce, people want to buy something, they go search. But for Pinduoduo, and now there's many current version of social e-commerce, they buy because friends share their experience and the product, and you got impulse to buy. That's a totally different incentive. So once you understand that, you feel that the social network change, the new generation behavior change, now give a lot of things new opportunities, even it's already been well established. So I saw news today that Warren Buffett exit from Walmart after 20 years. It's a signal that he think e-commerce is taking over everything. But now in China, social e-commerce even stronger than the traditional e-commerce. E-commerce is already a traditional business now. So that's how fast things move forward. We've been very exciting. Another thing we are very excited about is, I think in past 20 years, internet mostly being using to solve the connection and efficiency issue. But there's many areas in China, the issue is not efficiency. It's a lack of good supply. For example, education and healthcare. It's very difficult to find many good doctors and teachers. But now technology like AI really can make a difference. In US, when my colleague in Klein are trying to invest in AI, they may want to invest in cutting edge technology like using a pure AI avatar to do education. That's the way Silicon Valley do it, right? But in China, we have a human plus AI, using the real person and the AI to support, to solve the scalability issue. We just made one investment. I feel very exciting. I cannot tell the name yet. But that one, I feel is the future of education. So there's many things. Again, anyone want to stay with early stage investment, they are very passionate about that, not about only about money. Yeah.
Sure, of course. Wayne?
Sure. Okay. General background or?
Yeah, give us an overview.
Okay. So I started after school. I started with startups 20 years ago, roughly in China. So I see the changes in landscape and it's totally different. And I moved on to equity research in 2004. And at the time, I was covering names like Sina, Sohu, NetEase, and when those penny stocks started to make big changes, and we took Baidu public, so with a firm called Piper Jaffray at the time. And then I moved into VC, which I thought is really interesting, and building companies from zero and from scratch. And then I
That was with?
right, W. Harper / Matrix.
Sure.
W. Harper initially, and then Matrix launched in 2008. And I met James in 2005 or 6 when he moved with Google to China, and Wei when he came back from Wharton at the time. And then
You all have known one another for a long time.
a long time.
And you all do deals together too?
Yeah, we have overlapping portfolio companies, right?
Yeah.
James and I were in a few deals together, and Wei, both in Kleiner days and today, we're looking at similar, some similar sectors. And we see a lot of changes in the industry during the past 14 years. And I think probably the way I see it, the first wave of innovation is probably coming to an end, or kind of the end of the beginning. Right, the internet is already there, and the connections already happened, and everyone is online with multiple accounts, and all the devices are online, and we're going to see more devices online through IoT and stuff. So connecting things, connecting people, that the first part of innovation is already there. And so that's why we see the changes in Tencent moving into industry innovations and empowering traditional business with technology like AI and other stuff. And so for us at China Growth, which I actually joined only 6 years ago, and we're running a kind of tech investing venture shop, and only four major theses: fintech, enterprise, marketplace business models, and deep technology. And so for us, we think because our average fund size is only 150 million, and those guys are, I think, are way bigger, or at least 2 times or 3 times. And but in total, we're managing a 1 billion asset. So we think we have to pick companies early, and we have to focus on what we do best. So we've avoided a lot of traditional internet sectors like social media, advertising-driven business, and some kind of traffic-driven business models. And what we're focusing on are a lot of technology, or at least kind of data-driven applications. And if you look at fintech enterprises applications, we see a lot of things going on. And also, recently, especially from this year, a lot of people started to talk about enterprise applications and 2B and things. And we think it's going to happen because the device is here, and it's no longer like 20 years ago, even 10 years ago, when we look at enterprise applications, the companies, the customers will have to buy devices like Symbol, right? If you remember those large kind of barcode scanners, which cost $1,000 each device. And today, everyone has his own device. So data input and output becomes easier. And also with a lot of the uprising Chinese startups like Meituan, like the Mobike, and so the data format and the velocity of data is changing. So those companies are generating a terabyte of data every day. And 10 years ago in China, our companies are doing probably one terabyte of data 1 year. So the 4 V's of the data is making impact on the infrastructure level of the software. So we think software is going to change, hardware is going to change. We recently sold one company, Xilinx, which is working on the AI kind of architecture. So and also given the recent U.S. and China trade tension, we think China, it needs to source its own proprietary technology. So not just semiconductor manufacturing technologies, but also a lot of kind of infrastructure level software technologies. So yeah, so we're pretty deep into technology stuff.
Okay, very good. Thank you. And Zhengdong, I certainly don't want to overlook you at all. So tell us about you.
Sure. Long Hill Capital, just like Wei's firm, we're also a very new firm. We got started in November 2016. Myself, I've spent 11 years leading the China investment effort for NEA. And afterwards, we spun off in late 2016 and started Long Hill Capital. So unlike many of my esteemed colleagues here, we're actually not a TMT venture firm. So we focus on investing in healthcare and consumer businesses that serve the aging population in China. So that is our focus. And this has been a big year for us. 3 months ago, we raised our second fund, which is a $270 million fund, and also our first RMB fund. So the total has taken our total capital under management into close to $500 million at this point. We have 15 people on the team, initially in Shanghai, but 3 weeks ago we opened our Beijing office as well. So this has been a big year for us. In terms of what excites us, I'll just touch a little bit about healthcare, because some of the panelists from this panel and the earlier panel talked about that. What excites me most over there is I think the world is really changing in that it is, everybody think about healthcare as a very deep but complex sector, very hard to tackle, very hard to change. I think that's in many ways still true. However, I do not think this is our grandpa versions of healthcare anymore. So we're talking about monolithic large systems full of buildings and equipment. I think just like all these other tech businesses or tech-enabled new business models, the most important thing for the future for healthcare is technology, team, and business models, right? And so, others have talked about AI. So, for example, one of our portfolio companies, I had the pleasure of investing 2.5 years ago in the Series A, called LinkDoc, which is an oncology-focused AI company. And what excites us there is, people always thought about, healthcare AI, it's always diagnostic, some kind of automatic radiology imaging scan. That's all there is. And there's a question of how do you actually make money there, because no software has been approved as a medical device and won't be until probably 18 months from now. And then even with that, how do you actually sell it, right? That's always been a question. But this is a company, I think, in a matter of less than 3 years since they started the company, they are now a partner with over 1,000 hospitals in China, accumulated full patient data on over 3 million cancer patients, adding about 200,000 a month. At that pace, by the way, China has about 4.5 million new cancer diagnoses every year, which is #1 in the world, unfortunately. but close to 50% of that is going to be admitted to this one company. And this is our first year of revenue, and it has gotten from almost zero last year to close to 70 million this year. But on the offline side, it's almost, as a technology company in healthcare, it's somewhat expected, right? You do new things, maybe you'll generate revenue. But we're also seeing, tech-enabled businesses, offline service business. There are, 3 clinic businesses in our portfolio. All 3 of which have shown, 20 to 30x growth over the last 2 to 4 years. Well, this is perhaps nothing compared to Pinduoduo as a pure tech-driven business, but when you think about clinics and how they grow, you actually have to build one after another. You have to actually, see patients and recruit doctors and all of that. To be able to grow that much in a short period of time, it was not possible, and I couldn't have never foreseen this, let's say 10 years ago. And so that's what makes me excited every day and to go to work.
Okay, good. Let's. One of the things that I keep hearing about in various interviews is that the feedback is that there's really not enough capital to invest in all these new ideas coming up from China. But almost everyone here on this panel has raised a new fund, so I always point that out. I said, but yeah, look at all these new funds that have come up, and it seems to me like there's, ample financing. So what's your view? There's ample financing. Okay, because the size. What I think we heard about the size of the funds for everyone except for Lightspeed. Lightspeed China is the size is.
We can't really comment on any. We have a closing coming, and it's pretty substantial increase. But just generally, we have a press here. But in general, I think the institutional investors in the U.S. and they are looking at China actually is a very, very substantial venture opportunity. Yeah. Performance higher than the U.S. counterparts, and the top 20 global internet companies in the world, 9 out of 20 are Chinese companies. Yeah. The other 11 are Alphabet, Amazon, Apple. Average history is 20 years, and the 9 Chinese company average history is only 8 years. Yeah. And so the smart money definitely is coming. And although renminbi is kind of drying up a little bit because the banks are stopping providing some of them, but yeah. I think that's making it a little bit more healthy to invest.
Okay. So, this is one of the things I've heard about the RMB funds.
Sorry, let me make one more comment.
Yeah, sure.
Money is, there's more money, capital being poured there, but we have to understand that there's also new things happens. First of all, innovation really happens in China. Actually, we used to be copied from US, right? Copy to China, but now many US companies copy from China. Yesterday, Facebook just launched the video product. It's 100% copied from Toutiao's Douyin.
Right.
So actually, I just invested a company based in Singapore. They're looking for money from China. I just invested because he thinks that all the new business model for entertainment innovative happen in China. So he want to copy from China and build all kinds of product in US. That's the reason he want to raising from China. So that's money, as a previous panel discussion about Southeast Asia, right? There's a lot of Chinese entrepreneurs trying to expand to global. So those kind of money will support them to do that as well.
Well, talking about the innovation thing, I mean, the bike sharing thing just took off like crazy 2 years ago, but now it's like dead almost, it seems. You look at these bikes, they're in such bad shape, right? I mean, I saw one with its seat gone and its wheel gone and its steering wheel gone. There was almost nothing left of this bike that was parked there or docked there. I mean, what happened to the bike sharing, the sharing, this thing that was supposed to be so revolutionary and didn't? What happened? What mistakes happened there?
Actually, for me, I didn't invest because when the mobile chance come to me, I don't have money. I'm raising money. But I still love this business model. Okay, I think the competition was too strong. That's the issue. Too much money injected in different competitors and they fighting too much. The business model really makes sense in China. Even they charge a little bit, but think about it. If you travel to China, you know from subway to your office, maybe there's still 1.5 kilometers. In Beijing, it's not a walkable city. Most of the Chinese city are not walkable. You need some kind of transportation. In parts, you have to use in the buggy, right? For 10 yuan, it's very dirty and very dangerous. But now with 2 yuan, you can ride bike. The issue is everybody competes so much, they cannot charge too much. But the willingness to pay, I think, is still there. So after this round of cleaning house, right? The survivor, I think, will be still healthy. That's my view.
The survivor seems to be Mobike, which was acquired by Meituan.
Yeah, maybe.
So, yeah. So, but OFO, I hear not so great future, but we'll see. But what about these companies that are growing so fast and continue to lose money, lots of money? Is that going to be a sustainable thing long term for these companies that are super speedy growth in the tech wave in China?
Okay, me. When in 2008, when I tried to invest JD.com, people ask me, this company have 2% margin, gross margin. How can this company make money? Even before JD IPO, still people ask me, how can this company make money? But look at the financials now, it's different. So the key is not the growth speed, etc. It's about what kind of value they provide to user. If they provide enough value, they can charge premium, and they definitely can make money. Actually, I'm not worried about any company. If they really provide value in China, I never worry about their profitability long run. I worry maybe they will be evil, charge too much in future when they dominate the market. Right. That happened already, right? I don't give the name, but people know what company I mentioned. So when Kleiner Perkins US invested in Amazon, the same situation. People question about this business model. Look at how profitable Amazon now is. So when you're looking at the internet business, they are targeting, most of the company are winner takes all game. Once they win, they will make a lot of profit for sure.
So let me just ask another burning issue question about the U.S.-China trade and all the frictions there and the investment flows. How is this impacting how you do business? James?
Yeah, I think definitely we see the IPO trading price, right? A lot of them are traded below IPO price. The hedge fund managers are really pricing it as kind of a worst case scenario because the trade war, I don't think it will resolve very quickly. So short term, there's headwinds for a lot of the traditional business. Although for us, I think a lot of us invest in these tech business and leveraging tech to disrupt traditional industry. So when the traditional company are struggling, actually, it's better opportunity to change. And the Wayne kind of alluded to that in the deep tech space, and we think that's actually creating even bigger opportunity. Because you think about the internet, now we have over 60 Chinese company went public in China, right? Their Chinese company definitely has some advantage. At least it's easy for Chinese company to get ICP license, right? So there's certain barrier available. So, but for deep tech, historically, Intel, EMC, and everybody sells very well. But what happened to ZTE that wakes up everybody, right? And they can't take the chance to say, I only buy single source from a US deep tech company. And so this is, we have, for example, we invest in a LiDAR company for self-driving car. They compete with Veridine head-on and almost same pricing. And it's profitable already, 6 times gross revenue. But their customer base is almost 100% US-based and European-based. But they are getting so much requests now from the Chinese company, and they said, I can't imagine that self-driving car in China in the future, if there's something happens, you can buy a U.S. lighter, that there will be a problem, right? So these deep tech opportunities, I think, actually is very attractive to us.
Xingdong?
Yeah, I was just going to say that, you know, I think almost all of us on this panel are investing things that are by definition less prone to the impact by this immediate trade friction, because we invest in the new economy part of China. Right, and a lot of it is domestic focused. There is international expansion potential, but a lot of it is U.S. focused. And actually, I think Wayne and I we share a portfolio in an online marketplace for psychotherapy. You know, the CEO came to our annual meeting last week, and some of these industries are just more counter-cyclical, and love what she said about, and she told the audience when I started talking about the trade war and all of that, and she said, if you're not happy, come to us.
But I want to comment. So at one, a real challenge for us is to how to move talent kind of across borders, right? So how to fund a kind of U.S. trained scientist, or even some Chinese, or with a U.S. passport sometimes, and but the market is here. So that it was not a problem years ago or even last year, but it's becoming a technical problem we have to address, and where you put the IP to, right? Where you could whether you should incorporate the company in Delaware, or of course every company is kind of VIE structure, Cayman company, but can you build a lab in Cambridge or Silicon Valley with the business going on in China? So those concerns are starting to emerge and become kind of real battle problems.
Yeah. No, you see things cropping up, and then, you know, in the news, like, well, you know, why does Baidu have an AI lab in Silicon Valley that's, you know, that the employees are, you know, they're taking jobs away. Anyhow, these are all issues. Glen, let's hear from you.
I think on a day-to-day operation perspective, at least for us, it's not much affected by the trade war. But I think if the trade war become prolonged, I think it will affect people's confidence and definitely affect, you know, the macro policy. And that will, I think, will trickle down to, I think, affect every one of us business in the longer term. So we'll see what happens end of November.
Do you think that this is impacting the stock prices of these Chinese companies, these Chinese tech companies?
Yes, I think so. I think, you know, now, I think probably 10 years ago, there's the Chinese stock like C-Chip, Homings, those type of stock. When they go to the U.S., there's a China premium. But these days, there's probably a China discount for a lot of the, you know, the Chinese companies, even though the fundamental is very good. You know, if you look at Baba, from a GMV perspective, it's actually much bigger than Amazon. But if you like the trading multiple, I think, you know, it's not even close, right? So I think there's a China discount factor into it, and the trade war sort of, you know, just to exacerbate that. So I think, you know, hopefully we can get it resolved, you know, pretty soon, hopefully.
Yeah, hopefully. But so Hong Kong certainly has attracted a number of high-level IPOs. Do you think that has anything to do with this? And do you think that New York is going to have, you know, more of a challenge attracting some of these high-level IPOs in the future just because of this China pushback? James?
I think so far Xiaomi and Meituan pick wasn't really a China pushback from U.S. But when you read the news that the White House senior advisor was proposing internally that banning the visa for Chinese students, that caused some concern, right? I don't think it will happen, but so people are looking at not just U.S., but I think for the largest marketplace company, the platform company, they still will go to U.S. because they have the most sophisticated long-term investors. They don't necessarily listen to the politics.
Okay.
But Hong Kong will become more meaningful, and also I think for deep tech companies, A-share listing will be very meaningful, very favorable.
And the M&A market, I mean, from China to the U.S. has pretty much dried up, right?
You have to go to CFAs. It's almost impossible to acquire or invest any of the U.S. tech companies. And I think the European market is closing very quickly. So people are looking for technology to invest or going to Israel. And
Or Southeast Asia, right? Yeah, Israel, sure. Or Southeast Asia, which we heard about, but it definitely Israel. And does this trade war impact capital raising for your funds?
we don't see it at all.
No, they're
Actually,
all the international LPs out there are racing to get into your funds.
I think James have a very smooth fundraising experience this time. Actually, the reason I come here, this AVCG, I don't need to be here because we just closed a fund, working very busy to make investments. The reason I come here is because I want to test the water about next year.
Sure.
The
Sounds
impact,
good.
yeah, definitely there's certain level of impact. Every limited partner meeting I had in past 3 days, we spent like half of the time talking about next year's, the impact. What do you think? So I think we are TMT early stage investors, most of our investment target will be less impacted because the traditional manufacturing business will be heavily impacted by the trade war for sure. So the limited partners, of course, they will figure out what will be, what level of impact they will have. But I always tell them that good things also happen in China because one of the key things happened, Chinese customers started to really pay a lot of money online now. So the profitability from China really coming. In past, we always use eyeball comparable to make valuation. But now the profit foundation support the valuation itself. So this trend will make the competent compared to the trade war facts, I think.
And it's still in its early days in many ways. If you talk about e-commerce, it's not that huge percentage of the marketplace. If you talk about new retail, that's kind of a whole new area that's developing. But we could continue on, but I think in the interest of time, and because we still have to get to our awards before this evening ends, we're going to wrap it there. And let's just get a photo, please, Mr. Photographer. Okay, sorry. Thank you.